A very happy Thursday to you and welcome to our next edition of the Elville webinar series. I'm Jeff Stauffer, Community Relations Director with Elville and Associates, and I'll be your moderator today. Our topic today is the Family Opportunity Mortgage, empowering families seeking to provide housing for loved ones. And our very special guest presenter today is Marie Ritzenberg, home loan consultant with Main Street Home Loans. Just a bit of background, Marie has been a longtime friend of the firm and supporter of our webinar series. She visited our office about 6 weeks to 2 months ago to share some information about the Family Opportunity Mortgage with our attorneys and staff. And we immediately thought this would be a great information sharing session that would be ideal to share with our clients, our advisors, and guests for our webinar series. So here we are. And this is the first in a series of educational presentations that Marie will be offering over the next several months with us. So a few general housekeeping items as always, and we always encourage your general questions. So please note them in our questions panel or chat on your screen, and Marie will pause periodically to address them. Your questions always add a lot of value. They help others learn, so don't be shy in posing your questions at any time. And earlier this morning by email, you received today's presentation slides Marie will be referencing, and these slides are also available in the section marked handouts on your screen to download at this time. Everyone will also receive a post-webinar feedback email right after the presentation, so please take just a few minutes to fill out this brief survey and offer us your thoughts about today's presentation. And we always read and value every comment that you have to share with us. And here at Elville and Associates, we are always here as a resource for your family and you. If you have new planning needs to address, old documents that need to be reviewed, which is not out of the ordinary, or perhaps another matter, Managing Principal Lead Attorney Stephen Elville and our team are always here to advise and counsel you every step of the way. So now I'd like to turn it over to Marie Ritzenberg. Marie, thank you so much for being here. It's been a pleasure to be speaking with you over the past 6 weeks or so and getting to know you even better and having you here today to share some great information with our attendees.
Thank you for having me. Thank you everyone for taking the time out of your schedules today to hear the information that we'd like to share. This is a mortgage program that is rather underutilized in today's market, and this could be a phenomenal opportunity for you to help you and your family members grow wealth through real estate and provide additional opportunities for your family. So just a little bit of background about myself. My name is Marie Ritzenberg. I work for Main Street Home Loans. I've been in the mortgage industry for almost 21 years now. I serve on a couple of networks. I am currently the first vice president of the Women's Council of Realtors Howard County Network, and I'm also an ally in the industry as well. Main Street, we are a national company. We're a division of NFM. So I personally am licensed in states myself, so I can help with most of the East Coast, wrapping up a couple of more states for licensure, and that would finalize Pennsylvania down south through Florida within the next month or so. So where I personally can't help, I have teammates that can. We're licensed in 48 states, everywhere except for Hawaii and New York currently. We have tons of financing programs. Could be something very vanilla, could be something rather unique. We really try our best to provide opportunities for our clients to make sure that they can afford homeownership. So today we're going to be talking specifically about the Family Opportunity Mortgage. It's a unique program. There's traditional ways that clients purchase real estate for their family, so we're going to dive into the pros and cons of this particular program, as well as comparing the other ways that most people have acquired real estate for their family, oftentimes looking at an investment property or a non-occupant co-borrower. We'll discuss requirements to become eligible, and of course, as Jeff mentioned, we'll certainly have a Q&A session as well. So what is the Family Opportunity Mortgage? The Family Opportunity Mortgage is a program that helps individuals purchase a primary residence for a family member. The family member that they are purchasing the home for has to either be their disabled child or their parent who may not qualify for a traditional mortgage otherwise. Thinking about where interest rates are and where affordability and inflation is right now, the cost of living we all are experiencing has increased. So it's become somewhat challenging for many individuals to obtain homeownership for their family members. Just kind of painting a picture. Imagine my mother-in-law on a fixed income that may not have a significant nest egg of savings pattern. If she were trying to purchase a property today with interest rates hovering around 7% on a fixed income, that may be challenging for her to live in an area that she would desire. Vice versa, if you have a child living at home, specifically a disabled child, you may want them to gain that independence. Everyone wants our family to live well, live happily. So, of course, providing that opportunity could be significant. So most mortgage programs allow one primary residence transaction within a year. So if I own my current home, a single family home in Howard County, and I want to purchase that property for my mother-in-law, if she wanted to also reside in Howard County, how would that make sense for me to potentially have two primary residence homes in the area? Normally, looking at the way we would normally qualify could be, Marie, you live in a single family home in Howard County. If you want to buy a townhome in Howard too, that kind of smells like an investment property. So guidelines oftentimes require a higher down payment, higher interest rates for investment properties. Another alternative method to look at qualification in that scenario could be a non-occupant co-borrower, where if she were the borrower on the loan, I could help her qualify as a non-occupant. I'm not occupying the home, I'm just helping her qualify on paper. So in that case, the mortgage is in her name as well as mine potentially, as well as that loan is now on her credit report. So do we want that obligation for her? Question mark. So certainly something to consider. With the family opportunity, you're looking at a down payment that's based upon a primary residence. Same with the interest rates. Those are interest rates based upon a primary residence. So several things that make up what rate someone may receive on their mortgage would be the occupancy type, primary residence, second home, investment property, their credit score. Do we have a credit score? What type of score is that? Scores range between 350 to an average of about 850. So we pull the credit report from all three bureaus, and the lower of the borrower's score is what gets used. So if I have a 780 and the other client has, a 650, the 650 score is what will be used for that risk and the qualification. The higher the credit score, the lower the risk, the better the terms. Vice versa, the lower the score, the higher the risk. Not as many products may be available and or potentially at higher level interest rates. So this isn't a great option to provide that independence and to gain the freedom for their family member, and also maybe free up that extra guest room in the home to give the family member full utilization of their home back if they have family living with them. As mentioned in this slide as well, lower interest rates, lower down payments. So we're going to get into a comparison of how this program would impact someone with the monthly payment as well as the cash out of pocket, comparing primary residence versus second home or investment property. The requirements for the program presently, this year, 2024, according to Fannie Mae, so this is, if you see me looking over here, I've got an additional screen. Fannie Mae, they have to show that the borrower can demonstrate that the parent or child is either unable to work or does not have sufficient income to qualify for a mortgage on their own. The home has to be the primary residence for that family member. Down payment as little as 5%. Of course, closing costs are in addition to that down payment. Closing costs are an average of about 4% in today's market. Credit score minimum for this product is a 620 or better. And the borrower's debt to income ratio has to be 45% or less. So when we're looking at that borrower's total income, we're looking to see what your income is, what your debts are, meaning your current housing obligation, plus this new housing obligation, as well as any other debts, car loans, personal loans, student loans, credit cards, things of that nature. So we look at that total portfolio and we have to have a total of 45% or less. We're not using any rental income to offset this mortgage payment because this is a primary residence. And we do have to do a full verification of income and assets as well. And lastly, we do have to document that the family member, that child or parent, cannot afford that property on their own. So for example, if they are working, we would get their pay stubs. If they're on a fixed income like Social Security or SSDI, for example, we would get the Social Security awards letter to verify what their income is, to show this is what the housing payment is, here's their income, this program is the best to suit this situation's needs. And Jeff, I'm just looking in the chat box to see if there's any questions so far. Correct me if I'm wrong, I don't see any just yet.
Thanks, Marie. We just had one actually come through, so I will go ahead and pass that your way, literally as you said that.
Can the borrower use a VA home loan program? That's a good question. So this is a conventional loan. So mortgages are either conventional, government. Government would include the VA loan. It would include FHA, USDA for the government products. This is a conventional product. So no, you cannot use this specific scenario with VA. With VA financing, one of the benefits with a VA loan is that it allows up to 100% financing. So you don't have to have a down payment, but it is for a primary residence on a VA loan. And those individuals that are on a VA loan either have to have a VA certificate of eligibility to show that they have completed their service and they were either active or reserve. So we would get their certificate of eligibility. And if you have multiple borrowers on the loan for VA specifically, not for conventional, for VA specifically, if we have multiple borrowers, we usually have to have documentation that each borrower is either VA eligible or that they are married to each other. So this program, Family Opportunity, is specifically for conventional financing. Just to add to this VA question, you can have more than one VA loan out at a time. That is a bit of a misconception. Many people think that they have to pay off or sell their property that has a VA loan. You don't. Depending on how much is left on the current VA mortgage and where the person is purchasing, we can calculate how much VA eligibility they can utilize for the next purchase. But home ability, or the Home Opportunity, is a conventional product. Let's see, how is a pay statement tied to disability? So for example, let's see, if the individual is in receipt of SSI or SSDI, we would get documentation of that. If the disabled individual is working, we would get documentation of their pay stubs to show how much income they are generating. And we would use that 45% or less debt to income ratio calculation to see how much can this individual qualify for. So let's just say, for example, the individual makes, let's say they're working at $20 an hour, and they're working, full time at 40 hours a week. So $20 an hour times 2,080 hours a year is $41,600 a year. Monthly is $3,400 a month. 45% of that would be $1,560 for qualification. If the individual doesn't have any debt at all, then that's how much monthly mortgage payment they could qualify for, $1,560. So we'd have to reverse engineer how much does that afford them in home. In that circumstance, it may be somewhat challenging to find something in their area without a significant down payment to support a $1,500 mortgage payment. Is there a program for mortgages for disabled low-income persons to take out on their own? That's a great question. There is a product that is due to have their funding replenished this fiscal year in July. I did not include too much information about it today in my presentation, specifically because I don't know if their guidelines will be changing when this account or this program gets replenished. But I will tell you what prior guidelines were. So, and we can do a follow-up and an update and an email blast once this program does get additional financing. But it's called the Home Ability Program. It is provided by the state of Maryland. We are one of their gold level lenders with the state. And the Home Ability Program offers a low down payment as well as down payment assistance funds to individuals that are either disabled themselves or if they are a caretaker for someone that is disabled. And so the prior guidelines were that they could get up to $45,000 to use towards down payment and closing costs. The first mortgage was usually an 80% loan to value threshold. There were caps on the amount of the loan amount, but there was a standard first mortgage. We would do a first mortgage of 80% loan to value, and they could get 25% of the price with a cap of $45,000 to use towards the down payment and closing costs. So in that circumstance, because the loan to value on the first mortgage was based upon 80%, there's no mortgage insurance. And that can save somebody an average of $150 to $200 per month. So that's pretty significant. When they make their mortgage payment, they're only paying on the first loan for principal and interest, as well as property taxes and homeowners insurance. The 25% up to $45,000 cap that they got from the state does not have a monthly payment on it. So normally in today's market, $45,000 would be about a $400 mortgage payment. So their obligation is much less because they're not paying on that secondary lien. Now, they have to repay that lien when they sell the home, refinance the home, or 30 years, whichever comes first. So essentially it's free money. It does not accrue interest. It does not have a monthly payment on it, but you have to replenish the pot and keep it going and repay those funds back to the state. So that's an amazing product. Those are the prior guidelines. Once we learn more, hopefully within the next 45 days or so, we will certainly do a follow-up and blast that information out. And based upon new guidelines, what's changed, we can certainly see how this may help your families. Let's see, the next question is, do you have to prove this? So couldn't this be offered to a parent buying a home for any child with limited income? So that is a great question because I personally have been trying to work with Fannie Mae to look into this product further, specifically for, let's say, students. If you are off at college, for example, normally you have to live on campus for the first year, and many students move off campus and are usually there for maybe the remaining 3 years, give or take. So many students are studying full-time or perhaps studying full-time and working part-time. You don't see too many full-time students also working full-time. So at the moment, with Fannie Mae's guidelines, you do have to prove that you are purchasing the property for either a parent who can't afford it, whether the parent is disabled or the parent is on a limited income. But the guideline for the parent purchasing for the child, the guideline is you do have to prove that the child is disabled based upon Fannie Mae and their guidelines. If we can change the world with getting that overturned, we'll certainly keep you posted, but I've been working with them for a few months on it and haven't gotten anywhere to change that guideline. Okay, looks like we're complete with our current questions, so we'll keep going here. Let's see. So for the special needs children, as mentioned, the borrower must be either unable to work or have a limited income. As mentioned, it normally something that smells like investment property. If I own in one area and I want to purchase something in the same area that may smell like investment property, there is not a distance requirement for this product, which is really nice. Occupancy could also include a second home, like second home normally is a resort area. Deep Creek, Ocean City, Bethany, Dewey, Rehoboth, Florida, North Carolina, South Carolina. If I have a vacation home, usually a solid 50 to 100 plus miles away, that would look like a second home, a vacation or resort area home. But if I want to buy something for my family member in town, that does not make sense as a second home vacation home. That would normally mean that I'd do the non-occupant co-borrower scenario or investment property scenario. Let's see. The disabled adult is not required to be on the loan with the borrower. I think that is really significant to mention because do you want to obligate someone to a debt that they may or may not be willing or able to repay? So is this individual working? Do they even have a credit score? Like, do they have any debt in their name? So what would allow this person to qualify for the mortgage, or do we want to even have that risk affiliated with their credit and their history? So that's certainly something we can talk about too, but there's different ways that I look at things when I help individuals qualify in general. If it's two people that come to me and say we want to purchase a home together, I look to see what can this one do, what can that one do, and what can you both do together, just to see, do I have to have you both on the loan? If they're both first-time homebuyers and only one of them purchases, then the other one still has their first-time homebuyer opportunities to use in the future. So looking at it from different angles is always helpful because it's the book that we're looking at, not just this next chapter. So if this chapter allows one to purchase a home and then the next chapter allows the other one to purchase a home, now they've got two properties and have their first-time homebuyer eligibility in the future. So do we want to have our disabled family member obligated to that mortgage? If it's a $200,000-$300,000 loan for 30 years, do we want to obligate them to that? Of course, there is no restriction to age when it comes to someone taking out a loan. You could come to us at 90 years old and get a 30-year fixed rate mortgage. So that's something to also consider too with our aging parents. This allows the adult to purchase or refinance the primary residence for their parent. The parent that is occupying the home, you either have to prove that you cannot work or have a limited income, so you can't qualify. And again, same thing here, no distance requirement, and the parent doesn't have to be on the mortgage either. So it's certainly something to think about, committing someone to a debt and an obligation. What is their credit like? Do we have to have them on the loan? So being on the mortgage and then being on title are often two different things. When we pull credit, we're going to see that person's debts and obligations on that credit report for the tenure that they have that loan. We'll dive into title a little bit as well in just a bit. All right, so the benefits of this program is that this overcomes the challenges of traditional qualification. So normally we would see a primary residence for the, let's just work with this as the child purchasing, the occupant purchasing the home. Normally we would have the child on the mortgage and then the parent as the non-occupant co-borrower, meaning we're both on the loan and my income, my assets, my debts are used to help my child qualify for this home. And as question, do we want them on the mortgage? Do we want them obligated to that? Can they even repay it? Oftentimes when we're looking at a history for qualification, we look to see what is the borrower's 2-year employment history. Do they have steady employment? What type of income have they had? So these are all questions that we would look at for traditional qualification. So second homes, occupying as a second home. Usually that's the resort area vacation home. Down payment is on average about 10%, whereas the family opportunity mortgage only requires a minimum down payment of 5%. So the investment is at least double. Interest rates on second homes are a bit higher than a primary, on average about 1/4. And then does this location make sense for a resort area or vacation property? And of course, tax implications. I am no tax advisor, I work with one, so you always want to consult with your tax advisor and see what makes the most sense versus having a primary residence. Investment properties, normally the down payment minimum is a solid 15 to ideally 20% down. 20% avoids mortgage insurance, that drops the interest rate. The more skin in the game, the higher the down payment, the lower the loan to value, the lower the interest rate. So investment properties are an average of about 0.5 to 3/4% greater than a primary residence interest rate. And a fun fact with investment properties, gifts are not allowed. So we always have to make sure where the funds are coming from to complete a transaction. And if we find that there is a gift involved, that's not allowable for an investment property. And then of course, consult with your tax advisor in regards to implications. So I wanted to just show you a little comparison. We've got the primary residence or home opportunity mortgage in the first column, second home in the second column, and then investment property in the third. So as mentioned, the down payment for family opportunity is only 5%, whereas second home is 10%, and then in this example on the investment property, I did the 20% down option, just so we don't have mortgage insurance. Let's use an interest rate today hovering around 7% for the primary. The principal and interest is about principal and interest, property taxes, homeowners insurance, and mortgage insurance, because that would be required with a down payment of less than 20%. And mortgage insurance can be removed once you reach the equity position needed to get rid of it. We can refinance anytime. These don't have any prepayment penalties, 30-year fixed, vanilla, no balloon payments. So the primary residence home opportunity interest monthly payment is about $28.25 all inclusive. And this is assuming that the property is a $350,000 home. That's mentioned up in the upper right corner. So if we look at that 350 home now on the second home structure of financing, interest rate at about 7.25%, but the down payment is now 10% as opposed to the 5%. So a $35,000 down payment plus the closing costs and prepaids on top of that gives us a monthly payment of about $27.85 per month. What's that, a difference of $50 a month? $50 a month, that's not going to make or break much. You know, that's if you're lucky, a tank of gas, or maybe a lunch date out. So for double the out-of-pocket expense, the monthly payment's only impacted by $50. So, you know, keeping that 17.5 in the bank, divide that by 50 months or $50 a month, that's 350 months. You're breaking even in almost 30 years, 29.17 years. Pardon me. So keeping that money in the bank or investing it, if we can do the home opportunity mortgage, that would certainly make sense. And then the final scenario here of the investment property, looking at 20% down, that down payment would be $70,000 on the $350,000 property. Interest rate in the upper sevens. And the monthly payment is $26.55 per month. So if we take that scenario of the $28.25, $26.55, it's a difference of $170 a month. 70K versus 17.5, that's pretty significant too. So as you can see, as long as the qualification makes sense and we're able to qualify, this really can be a phenomenal opportunity to help your family get into something of their own. Questions so far on this chart here?
No questions, Marie.
Okay, very good. So is this program right for me and my family? You know, we've got to figure out, does this make sense? Can we qualify? We all want our family to live our best lives. And will this provide independence and opportunities and a better lifestyle for our family members? You know, it's certainly something to consider. The financials, obviously, the financials are very significant with our decisions, but also providing those opportunities for our families to gain that independence and live the lifestyle that they want and that we do too, and the lifestyle that we want them to have. This really can be a phenomenal opportunity to provide that lifestyle and the independence. In regards to title, this is always a great question as well. At settlement, we normally close this family opportunity mortgage in the name of the individual on the loan and an individual name on title, name or names. So let's say it's myself and my child. I could have just me on title. I could have myself and my child on title if I wish. However, given that many of you have a relationship with Elville and Associates, you always can update the title down the road, perhaps in the name of a trust. That way, the asset and the family is protected. So that is always a great alternative to think of updating title at some point. And we ran through that pretty quickly. What questions do I have?
Questions for Marie? Family opportunity mortgage. Marie have answered all the questions.
Well, I greatly appreciate everyone's time today. I actually do have a follow-up that we can send with a thank you, just comparing the primary residence and even the investment property and second home scenarios and showing the out-of-pocket, the investment, and if we were to take those investments over time, how that could work in your favor if we were to take advantage of this program and opportunity. So I'll include those financial handouts as well with our thank you.
And just that one your way there, Marie, and the first
so why
word there
can't
should be why. First word there should be why.
Yeah, that's a good question. So this program requires that we close in the name of the individual. So because we have the individual on mortgage, we would need the title to close in the name of the individual as well. However, am I understand? Okay. However, we can update title post-closing to include or update title to be in the name of a trust. So at this time of settlement, we have to close in the name of the individual. Am I understanding anyone? And my understanding, anyone can be listed on a title. So it depends on the loan program. Normally with government loans, the VA, FHA, USDA, whoever's on the mortgage can only be on title. With a conventional loan, that is different. So for example, if with the conventional loan, even family opportunity included, you can have the borrower on the title of the home. You could also add a family member to the title of the home at the time of settlement as well. So with a conventional product, you don't have to be a borrower of the mortgage to also be on the title of the house.
All right. And if you have any specific questions, certainly for your family situation, Maria is obviously available to talk with you directly, and her contact information is in the slides, and I will certainly provide that to you in my follow-up email that, as many of you know, I always send out afterwards, after all of our presentations. And so while we're waiting for any final questions to come in, I'll just again thank Marie for great information today and education as part of our webinar series here today. And our presentations move on. As always, we have, starting next Thursday, a great presenter, guest of ours, Max Reamer from the Quantum Group. He's going to be talking about life and long-term care insurance in today's marketplace. Max was a guest presenter at our client event in November and did a really great job. It's one of the most requested topics of discussion that we have here in our survey comments. So ask and you shall receive. And on May 29th, we'll have Steve Elville back talking about estate and trust administration, understanding that whole process. And that's our quarterly presentation we'll be bringing back at the end of May. And then Marie is back on June 13th at 10 o'clock for the second part of her series. We'll be talking all about reverse mortgages and renovations. Marie, you want to give a little sneak peek into what we'll be talking about on that day?
Absolutely, sure. So we'll be discussing how reverse mortgages can be used to either purchase real estate or even refinance your current real estate and how that can best be utilized. We'll also discuss renovation loans, and those can be used to not only purchase a home, but also could be used to renovate, refinance and renovate your existing home. And many people are choosing to age in place. So there are some great opportunities to renovate your current home, make it more accessible for your lifestyle, and we'll present the ins and outs of both of those programs next month.
Okay, sounds great. Well, until then, Marie, it's been a pleasure. And to all of our attendees, thanks for being part of our webinar series today. Hope you have a great Thursday and an even better weekend. Hopefully it won't rain. 15 of 19 weekends so far in 2024 have rained. But we'll get some sun this weekend. So have a great day. Thanks for being part of the Elville webinar series, and we'll see you again soon. Take care.
Thank you.